You ever see a headline about some brand new company, no profits, and it's suddenly worth $1 billion? And you just think, how? Well, today, that's exactly what we're going to do. We're going to pull back the curtain on this kind of crazy world of startup valuation and figure out how investors actually put a price tag on the future.
So, yeah, it really boils down to this one huge, baffling question, right? We see it all the time. These companies raising just insane amounts of money, and they're not making a dime in profit. How does that even work? It feels like it breaks every rule of finance we know. But believe it or not, there is a logic to it, and we're going to unpack it right now.
But, before we dive into the how, let's just take a second to talk about the stakes here. Because when this goes wrong, it goes spectacularly wrong. I mean, just think about some of these names. WeWork, with its crazy $47 billion valuation. Theranos, Quibi. These were the darlings of Silicon Valley, right? Valued in the billions. And then, poof, it all came crashing down. So, yeah, a huge valuation is absolutely no guarantee of success. The stakes couldn't be higher.
All right, so here it is. Here's the secret sauce to the whole thing. The key is understanding that you're dealing with two totally different worlds of valuation. You've got valuing the present versus valuing the future. And with startups, it's all about the future.
Okay, so let's break this down. When you're looking at a big, mature company, think like a Coca-Cola or something, it's all about what's happening right now. You look at their earnings, their cash flow, you use metrics like the PE ratio. The big question is, what is this thing worth today? But for a startup, forget about it. Their earnings are probably negative, right? Because they're pouring every single penny back into growing as fast as they can. So the whole game changes. The question becomes, what could this thing be worth in the future? It's a completely different mindset. And I love this analogy because it just nails the difference. Valuing a normal company is like asking, what's this cash-making machine worth today? It's running, it's predictable. But valuing a startup, that's like asking, what could this machine become if literally everything goes right? It's not about the machine today. It's about the rocket ship it could turn into tomorrow. A totally different ballgame. So if you're going to value the future, you can't use your regular old tools. It just doesn't work. So investors have come up with this specialized toolbox, you could say. It's got different approaches for tackling this problem. The main ones are the market, income, and cost approaches. And we're going to dive into a couple of the most popular methods from that toolbox right now. All right, first up, the investor's time machine. This is the venture capital, or VC method. Let's get into it. So what is the VC method? Well, it's this really clever technique that's been around since the 80s, thanks to a Harvard professor. And the whole idea is that you don't start with today. No, you start at the end. You imagine the big win, like an IPO or getting bought by Apple, say, 5 or 10 years from now. And then you work your way backward to figure out what a fair price to pay today would be to get that future payout. Okay, I know it sounds a little complicated, but it's really just 3 simple steps. Step 1, you have to estimate that future payday, the big exit value. Step 2, you have to decide how much money you need to make on this deal, your target return. And trust me, for a VC, this number has to be huge to cover all their other bets that fail. And finally, step 3, you just discount that future value back to today to find out what it's worth now. Okay, let's put some numbers to this to make it real. Imagine you're a VC and you're looking at this hot new AI startup. You do your homework and you think, you know what? In 5 years, this thing could be worth $500 million. So, boom, step 1 is done. Your expected exit value is $500 million. Now, step 2 is where the VC mindset really kicks in. You know that for every 10 companies you invest in, 9 might completely fail. So the one that does work, it has to be a grand slam. It has to pay for all the losers. So you set a really high target for your return, maybe something like 40% per year. It sounds insane, but that's what it takes to make the math work in this high-risk game. And here's step 3. This is where the magic happens. You take that future $500 million prize and you use that 40% annual return to work backwards to today. It's kind of like reverse compound interest. And when you run the numbers, you get about $93 million. That's what the company should be valued at today, after you put your money in, if you want to hit your goal in 5 years. Okay, so that was one way of doing it. Now for another tool in the box. Valuation by comparison, or the revenue multiple method. This one is way less about predicting the distant future and a lot more about what's happening right now. The idea here is actually super simple, and it's something you've probably done yourself. If you're selling your house, what's the first thing you do? You look at what other houses in your neighborhood sold for, right? Well, startups do the exact same thing. It's all about finding comparables or comps for short. And here's a great real-world example from the buy now, pay later space. What investors do is they look at other similar companies, either public ones or ones that were recently sold. They figure out what the market is paying for them. In this case, they're not looking at profits, but it's something called gross merchandise value, or GMV. That's basically just the total amount of stuff people are buying through their service. By comparing that to the company's total value, they come up with a multiple. It's a benchmark that tells you what the market thinks a dollar of GMV is worth. And once you have that multiple, the rest is actually dead simple. You take your startup's own revenue, let's say it's $5 million a year, then you look at the market and see that similar companies are being valued at, say, 8 times their revenue. Well, you just multiply them. 5 million times 8 gives you a valuation of $40 million. It's a really powerful, simple way to ground your valuation in what's actually happening in the real world.
All right, so we've looked at the tools, the spreadsheets, the math. But now we need to talk about the most important part, because none of these numbers are facts. They're not guarantees. They are stories. They are stories about the future.
Look, a valuation is really just an educated guess, a hypothesis. It's based on a ton of assumptions, that the market will be huge, that the team can actually build the thing, that people will want to buy it. And as we saw with WeWork, Theranos, and all the others, sometimes that story is just pure fiction. You can have the most beautiful spreadsheet in the world, but if the story it's telling isn't true, it's completely worthless. And that leaves us with one last, kind of powerful thought to chew on. If a billion-dollar valuation is really just a story, a really, really convincing story about the future, then what does that say about who succeeds? Maybe the most important skill out there isn't just about writing code or building financial models. Maybe, just maybe, it's about being the best storyteller.